Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Ehrman.
Hello and welcome to today's podcast. All right, this should be a good one, you guys. We're going to talk interest rates. Should they go up? Should they stay the same? Should they go to zero? I am not an economist, but that is what we are going to talk about, and that is today's subject. First, if you have not left a review, please do so. Scroll down to the very bottom if you're on iTunes, and you will find a place to leave a review there. If you're on some sort of different podcast app, can't help you. Sorry. I just learned about the iTunes thing, so sorry. If you need anything, you let me know, Mary Jo at withoutthebank.com, and I am happy to answer those questions for you. If you have purchased my book, and you want to have a consultation, there is a link in your emails. You're getting emails from me with video lessons, and there's a link in there to my calendar. So you can go in there and schedule an appointment. People, I am booking out right now at the time of this recording, and by the time this is released, I can't imagine it's going to be much different. But I am booking out anywhere between 2 to 3 weeks. Due to some travel in there, that is not typical, but get scheduled. Get scheduled. You're going to give yourself 2 to 3 weeks to read the book, and then guess what? We can visit. If you're not going to read the book, guess what? We can't visit. No, and no. You have to read my book or you have to read Nelson's book and then we can visit. But before that, ain't happening. Okay, let's get on that topic of interest rates. So it's so interesting when I hear farmers call and say, oh, the interest is just killing me. I am paying way too much interest. Let's just rewind the clock a little bit and go back to 1980, when interest rates were 23%. If you guys are just tuning in for the first time and you've never heard the story of R. Nelson Nash, the whole infinite banking concept came about because Nelson was stuck with 23% interest on $500,000 of land notes in the 80s. He had no idea how he was going to pay those. Think about that. 23% interest. You guys, we have interest rates anywhere between 2 and 7%. He was paying $67,000 of interest a year. And we're complaining about 5, 6, and 7% interest rates? I have a car loan right now at 2%. There are credit card offers at 0% for 18 months. If we look at the history of interest rates, we are in the lowest interest environment we have ever been in. And we are talking about the fact that we can't make it. I don't know this to be true, but these are my thoughts. If we lower interest rates, everybody says, well, that stimulates the economy. People go and buy more. My opinion, people go and buy more shit they can't afford. Then guess what? We have more debt lingering out there. Banks right now have more debt load than they did in 2008 and 2009 during the housing crisis. More debt today than 08, 09, and 10. What do you think is going to happen the next time we have a market crash? And I don't know when that's going to happen, but what goes up must come down. And we just keep printing money and printing money and printing money. And we just keep handing it out with low interest rates, and people can't afford the payment because they're buying and everybody's lending them money, just like 08 and 09. It was the bank's fault that people bought homes they couldn't afford. Really? I don't think the bank helped, let's be honest. But is it the bank's fault that I didn't manage my money? Is it the bank's fault that I didn't do a budget and see that I didn't have enough money to make a house payment? I don't know. I don't know what to tell you. That's my outlook on it. And I was reading an article that almost proved my point on wolfstreet.com. Wolf Richter. Don't know the guy. Never heard of him. Ever. But guess what? We have 90-day delinquent auto loans is at a higher rate today of $66 billion than in 2010. More delinquent auto loans today than in 2010. Delinquent auto loans jumped to 4.94%, above the rate in QE3 of 2010. What in the world? 22% of the auto loans outstanding are subprime. 68 billion are 90 plus days delinquent. That's 23% of all subprime auto loans are delinquent. Nearly 25% of all subprime auto loans are delinquent. You guys, that's crazy. So let's lower the interest rates so that people can buy things that they can't afford because they don't do a budget. And then when interest rates come back up, we can't afford it. What happens if we can't afford things at 1% and 2% interest? Then what? And who is that punishing? Low interest rates are doing nothing but punishing the people that are saving money. You don't get crap in a CD. Even the whole life insurance companies are having to reevaluate their dividend disbursement. Because looking long term, which you hear me talk about all the time, looking long term, we got to make sure that we can pay death benefits. Actuarially, everything's got to be stable. But nope, we're going to keep interest rates low to stimulate the economy. I mean, I am no genius. But I look at that and go, sure doesn't make a lot of sense to me. Because I'm going to go buy a more expensive vehicle because interest rates are lower, so my payment will be lower. Really? Does that make sense? Or could we still buy a vehicle instead of buying a $70,000 vehicle? What if we bought a $50,000? Because that's what we would have bought if interest rates are at 5%, 6%, and 7%. I hope interest rates come back up. Long term, that's going to be better. People might not be buying things they can't afford to stimulate the economy, right? We talked about this at Think Tank when I was there a couple weeks ago for the infinite banking concept. And Dr. Murphy was talking about the 19 long-term budget outlook. Guess what? Long-term, for our budget, for the U.S. budget, we have a serious problem on the amount of interest that's going to be due. A serious problem. And what is going to happen if something happens to the stock market? Which is pretty much a given. Our 10-year and 3-month bond inverted last summer? Since World War II, after every bond inversion, there has been a financial crisis. There has been a recession. When is our recession? It's coming up, my friends, and it's going to be bad. It's going to be worse than the last one. Because why? Banks are overlending. People are buying because of low interest rates. Why should I not go buy new furniture when I can finance it at 0% for 24 months? No brainer. It's like getting it for free. We are so financially illiterate in this country. Everything we buy is on a payment. We're buying stuff because it's 0% interest, stuff we don't really need. We are not thinking about our budget. We're not thinking about saving. And why would we save? Interest rates are nothing. We don't get anything on savings, 1%, 2%. Why save money? Interest rates need to come back up. It is not a fun thing. It absolutely sucks as somebody that is needing to buy things. It sucks. It sucks if interest rates are high, but it's also not any fun if you're a saver. And where do you go with your money? You can go to real estate, but there's a risk with real estate as well. If you're into apartments, even farm ground, I was told the other day by a farmer, farm ground is coming down in prices because commodities are dropping. That's what they're seeing in their area. I can't testify to every area because I don't think that's true everywhere. But we're seeing that stuff. If we want to make some money, if we want to be able to have a balance, we need higher interest rates. Again, I am no expert. I am not an economist. I listen to them. I don't even know what they're saying about it. But I look at the dividends from my insurance companies, and I look at what the companies are doing to continue to pay dividends, and I think, my God, do we need interest rates? We need higher interest rates. For long-term stability, we need higher interest rates. And common sense tells me that keeping interest rates low is not the answer because people are going and buying stuff they can't afford, and banks are in crisis mode because they are over lending. And I'm seeing that in certain states. When I go speak in different states, I'm hearing it. Banks are being audited by the feds and they are keeping collateral. They are not releasing collateral from farmers who are paying combines off, paying land off. They're keeping that collateral on their books. Why? Because they've overlent to other people and they need to make their books look good. Are they cooking their books? I don't know. I don't know the inner workings of the banks and how they manage their loans and what have you. But when a bank doesn't release collateral for you and you only have 25% of your net worth in loans, I'm going to start questioning stuff. You know, I'm only always getting one side of the story as well. But I hear it over and over and over and over and over. If it's not an ag bank, they may have overlent in the good times. And they're coming in and getting their fingers slapped a little bit. So guess what? We're going to take more collateral from you. You can't say anything about it because you need us more than we need you. We need higher interest rates. Plain and simple. I hope that makes sense. Makes sense in my little head. Anyway, I am planning a little book tour and we're going to do some Farming Without the Bank seminars in Brookings, South Dakota and Cedar Rapids, Iowa. So I will be in Brookings, South Dakota and Cedar Rapids, Iowa, March 22nd and March 24th. Tickets will be available soon. So if you are in those areas or around those areas, please be on the lookout and grab your ticket. I will have this on the Farming Without the Bank Facebook page. It will be on LinkedIn, Farming Without the Bank. You will be able to see this on Instagram. So everywhere. If you are big YouTubers, please go over to Mary Jo Ehrman on YouTube and subscribe to our YouTube page, because some of the stuff that I do on Facebook, I also put on YouTube, because I know not everybody is a Facebooker, and a lot of people close their accounts because they frankly just get sick of the drama. So anyway, you can follow me on all those platforms, but if you are around Brookings, South Dakota on the 23rd of March and Cedar Rapids, Iowa on the 24th of March, please go online, grab your ticket. It will be a 3-hour seminar. You can ask me all the questions that you like. Anyway, thank you very much for tuning in today. I very much appreciate it. If you want to leave a review, you can definitely do that, and I would appreciate that. If you have comments, questions, concerns, maryjo@withoutthebank.com, and I would be absolutely happy to answer those for you. You guys have a fantastic day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.